If you started investing today, knowing everything we know now, what would you actually do differently? Not the version people post online, the boring, unglamorous version that actually works. Let's talk about it, because most of what stops people from investing successfully has nothing to do with money. It has to do with psychology. Start with the biggest myth out there, that successful investing is complicated. It isn't. The industry benefits from making it feel complicated. Because confusion sells advice, subscriptions, and fees. But the actual mechanics of building wealth are almost boringly simple. The hard part was never the math. The hard part is managing your own behavior long enough for the math to work. Here's the market reality most people don't want to hear. Nobody, no matter how smart, consistently knows what markets will do next month, next quarter, or even next year. And yet, most new investors act as if there's a secret pattern they just haven't found yet. That belief alone destroys more returns than almost any bad investment ever could, because it leads to constant tinkering, chasing, and second-guessing instead of just staying invested. Which brings us to the myth of market timing. There's a very human bias at play here. We remember the times we got lucky jumping in or out. And we forget the dozens of times timing would have cost us. Our brains are wired to overcredit our own predictions and undercredit randomness. Study after study on investor behavior shows the same pattern. People who try to time the market tend to underperform people who just stay invested. Simply because missing even a handful of the market's best days can quietly wreck decades of returns. Now contrast that with the one force that actually rewards patience instead of punishing impatience: compounding. Compounding doesn't feel exciting. In year 1, or year 3, or sometimes even year 7. It looks almost flat. This is exactly why so many people give up right before the curve starts. To bend upward, the psychological reward doesn't match the timeline, so people abandon the strategy right when it's about to start paying off. And this is where behavioral traps quietly take over. Panic selling during a downturn. Chasing whatever asset just went viral. Checking your portfolio 5 times a day and letting short-term noise dictate long-term decisions. None of these are financial mistakes at their root, they're psychological ones. Fear and excitement move faster than reasoning does, and the investing world is basically a machine designed to trigger both, constantly. So before any of the technical stuff, the actual foundation of investing well is safety, an emergency fund, manageable debt, and enough stability that a bad month doesn't force you to sell your investments at the worst possible time. Skipping this step is like building a house on sand. It might look fine for a while, but the first real storm exposes everything. Once that foundation exists, there's a hierarchy of accounts that matters more than people realize. Tax-advantaged retirement accounts first. Because the tax benefits compound just like the investments do, and every year delayed is value permanently lost. Only after that does it usually make sense to move to standard taxable investment accounts. Inside those accounts, the unglamorous hero of long-term investing is the index fund, a simple basket that owns a broad slice of the market instead of betting on individual winners. It's not exciting. Nobody brags about index funds at a dinner party. But historically, low-cost, diversified index investing has outperformed the majority of professionally managed funds over long time horizons, largely because it removes the two most expensive variables in investing: high fees and human emotion. From there, portfolio construction is really just about matching your mix of assets to your actual timeline and risk tolerance, not the risk tolerance you imagine you have when markets are calm, but the one you actually have when your portfolio drops 15% in a month. Most people overestimate their own risk tolerance until they're tested by a real downturn. Execution and automation solve the last problem. Automatic contributions remove the decision point where emotion usually creeps in. If money moves before you have a chance to hesitate, second guess, or wait for a better time, you remove the single biggest point of failure in this entire process, your own psychology. Consider someone like Sarah, a completely average earner, no special financial background, who simply automated a modest contribution every paycheck into a diversified index fund and left it alone for years, ignoring the news, the panic headlines, and the temptation to tinker. She didn't outsmart the market. She just didn't get in her own way. And over time, that's often the entire difference between people who build wealth and people who don't. Which brings us to the financial industry's favorite trap: complexity as a sales tool. Complicated products, actively managed funds with high fees, and constant opportunities that require quick action all tend to benefit the person selling them far more than the person buying them. The uncomfortable truth is that boring, low-cost, long-term investing rarely makes anyone else money except you, which is exactly why it's rarely what gets marketed the loudest. In the end, the entire game comes down to one thing: staying the course. Not predicting the next crash. Not finding the next big winner. Just consistently investing, automating the decision, and getting your own psychology out of the way long enough for time and compounding to do what they've always done. The strategy was never the hard part. Sticking to it was.